Okay, welcome to Contrarian Investor Conference number 2, virtual conference. We are here as scheduled at 9:30. Before we begin, I just want to get a couple of disclaimers out of the way. So this virtual conference is being done in partnership with valuewalk.com and Breakout Point. Disclaimers: this event is not intended as investment advice. It should only be used for informational purposes. The opinions expressed here are purely those of the individuals who present them. Neither Contrarian Podcast nor ValueWalk.com nor Breakout Point have any responsibility for what is said. Hang on, I just had somebody sign in and now I need to mute them. And what else? So none of the organizers or any individuals associated with them have any positions in the securities mentioned today. As such, we do not stand to profit from any price movement that may result from the presentations today. Then housekeeping: audience members' microphones are muted or should be muted. They are muted. The only people who are not muted are the presenters. Let me see here. Jacob is now muted. Good. So each one of the 4 presentations will be followed by a short Q&A session. To ask a question, please use the Q&A function at the bottom of your screen. Obviously, questions will be monitored. As I mentioned, all other chat functionality is disabled. And the presentations, as well as this recording, will be made available to participants. And let me see here. And so if you, the recording as well, it says here you can request a recording, but I believe that will be made available. Sharing sign-ons, strictly prohibited. Do not do so. And finally, there is a strict embargo on media coverage until 11:30 a.m. Eastern Daylight Time. So about 2 hours from now. Okay, that out of the way.
Hello.
Hi, Jonathan. I can hear you.
Terrific. Sorry.
Good. No, it's good. It's good to have you. I'm going to kick it over to you right now. Our scheduled order, just a sec, hang on, Jonathan. The scheduled order here was that we would have David Neuhauser go first, but he had a scheduling conflict, and so the last minute we had to reshuffle a few things. So it will be Jonathan, followed by Andreas, followed by Ziggy, and then David will go last. Maybe David will be able to show up and go earlier. We'll see. But anyway, so, okay, Jonathan, you are on the clock, and so you have the floor now. So please go ahead.
Great. I just wanted to, first, can you see the screen?
Yep.
Great.
Maybe better to do presentation. There you go.
Perfect. Well, first, I just want to thank you for having me here. Let me just adjust this. There, perfect. First, I just want to thank the organizers of the conference for inviting me to speak today. I'm really excited to do so. And just a brief introduction. First, I'm just going to brief introduction of myself and the firm, how we come up with ideas, and then talk about 2 ideas that I think are particularly timely, and then I'll open it up for questions. So I'm Jonathan Boyar, the Boyar Value Group. We're a research and money management boutique. It was founded by my father, Mark, in 1975. Today's topic: the Dolan discount, an opportunity or value trap. Here's for the lawyers, full disclosure, both myself and my clients own shares in both of the companies I'm going to present today. I don't think you'd want me to present ideas that I didn't own, so I think that works well for everyone. Okay, so just a brief background. We're both an investment manager. We manage money for high net worth individuals, pension funds, institutions. We're also a research boutique, and we sell our research on a subscription basis to hedge funds, mutual funds, and family office. Our investment philosophy is really simple. We take a private equity approach to public markets. We look at each company through the lens of an acquirer. So for us, not only does a stock need to be cheap for us to profile it, but we need to have an identifiable catalyst on why the stock will go up in a reasonable period of time. And we're more patient than most. To us, reasonable period of time is 2 or 3 years. I'm going to go through very briefly on how we uncover investment opportunities. We're looking, we have a couple of lenses that we look for opportunities through. We love looking at companies that are not included in the major indices. We like complex ownership structures. We're big fans of, let's say, John Malone and his companies, because the way he structures them are so complex, most people just shy away from them. So it gives us an opportunity to use our analytical ability. We also like companies with low levels of sell-side coverage. And with what's going on with MiFID II, et cetera, it's giving us I think, a unique opportunity in the micro, small, and even mid-cap world where some companies are really orphaned. We really like looking at companies that are out of favor by sell-side analysts. We like to say sell-side analysts can tell you everything there is to know about a stock, except when to buy them. We also like companies controlled by founders we believe to be good partners, and that's one of the companies two of the companies we're profiling today. Spin-offs are fertile hunting grounds for us. We've traditionally found a lot of value in this area. I know Joel Greenblatt has written about this, and it's become a popular area to invest in. However, not all spin-outs are created equal. Every summer, we do a thematic piece on an industry theme topic that's out of favor. And last year, we did spin-outs and discovered that they've actually significantly underperformed over the past decade or so. But there are areas within the spin-out world that you can look at where you can hopefully make a lot of money. So that's something that's pretty interesting. And the two companies I'm going to present today are either a spun-out entity or the parent of the spun-out entity. Just very quickly, our competitive advantages is, we go where others won't. We think investing in micro, small, and mid-cap names, or names that are not followed, or areas or ways that you can rebut the efficient market theory. And the other thing is our research. We have been producing research and publishing it since 1975 to some of the world's most sophisticated investors, something we're very proud of. And we think having a dialogue with these investors where they are not afraid to tell us when we're wrong or ask us, very probing questions makes us better investors. So I briefly went through, who we are, what we do, and our competitive advantage. Now I know you're here for ideas, and that's what I'm going to talk about. The two companies I'm going to discuss are Madison Square Garden Entertainment and Madison Square Garden Sports. So investment opportunity or value traps. And just a brief background or history. And anyone who's a Knicks fan or a Ranger fan must, at this point in time, think I'm nuts. As why would you invest in a company controlled by the Dolan family? And if I was purely a sports fan and was judging by the records of the team, I would agree with you. However, we have a different view of the Dolans than most people. We've actually found them to be good partners to invest alongside of. We've been following the Dolans for a long time. We were shareholders in Cablevision. In around 2006, they tried to take Cablevision private, but the minority shareholders voted it down, and thankfully they did, as the Dolans ended up unlocking a lot of value for shareholders. One of the things they did was spin out Madison Square Garden. And because of the valuation and the great assets they owned, we decided to feature it in our February 2010 issue of our research service, and it became a decently sized position for our money management accounts. So why did we think Wall Street was wrong about the Dolans? Is, they always assign what people call the Dolan discount to companies controlled by them. You just have to look back at the history. The numbers don't lie. When they controlled Cablevision, they had an industry-leading dividend. They paid a very large one-time special dividend. They eventually ended up selling Cablevision to Altice at a price we never thought they would get. And, as I said, they spun out Madison Square Garden as well as AMCX. It's actually interesting. A lot of the issues they're facing, MSGE now and MSGS that they're facing now, are similar in ways when they spun out MSG in the first place. People were worried about the competition from the Barclays Center. To us, there's only one Madison Square Garden. There's a big difference between having a 20,000 seat box in New York City versus Brooklyn. So we weren't particularly worried about that. But the prospect, they were in the middle of upgrading Madison Square Garden, and the price tag went from, I think, $600 million to $1 billion. Everyone was up in arms about how expensive it was, including ourselves. But they ended up being correct that it ended up being a fantastic investment. Like then, the Knicks were terrible. There was a possibility of an NBA strike. Here, there's currently, obviously, because of Corona, we don't know when the NBA season will resume normally. So, there are similarities. And it's amazing if you look at the value of the Knicks and the Rangers, how much they've gone up since 2009. And that's due to a host of factors that I'll talk about shortly. But the numbers are staggering, and we believe that those numbers will continue to increase in value. So the opportunity. On April 17th, MSG split into two, both of which, in our opinion, are trading significantly less than our estimate of their intrinsic or private market value. The Dolans continue to control both entities through super voting shares. While many investors are hesitant to invest in companies with those, ownership structures, our opinion is if you have the right partner, it's okay, as long as you're buying it cheap enough to have your margin of safety, which in both cases we believe we do. So what is Madison Square Garden Entertainment? What does it own? So it owns the world's most famous arena, Madison Square Garden, a bunch of other iconic venues like Radio City Music Hall, Beacon Theater, Chicago Theater. It has a very large cash position and valuable air development rights. And it's also in the process of building the Las Vegas Sphere. And that's where the opportunity is because of such negative sentiment. So the Sphere, pie in the sky or legitimate opportunity? That's what's really weighing on shares of MSGE. The Sphere is the venue of the future. It's going to be built in Las Vegas. It's gonna be really cool. Look it up on Google, MSG Sphere. You'll see renderings, etc. And as a fan, as someone I would love to go, and the concept seems terrific. It's the $1.6 billion price tag that gives us pause. And to me, I think there are better uses of the cash, but we address that in our valuation for the company. So why do we like the name? In this environment, cash is king, and they have $1.4 billion of cash, which should help them ride out the storm, whether the Knicks play next year or not, whether there are concerts resume at MSG next year or not. They have the cash cushion to help them go through. And much of their revenue is also recurring in nature, and have multi-year agreements. So it's a very attractive business opportunity. And we also like the live entertainment industry. Obviously, there are significant near-term headwinds created by the coronavirus, but we're going under the assumption that in a year or two, things will start to go back to normal. And we think there's going to be huge pent-up demand. If you look at, and I realize it's somewhat self-serving, but if you look at comments by Live Nation, et cetera, we think that global demand for concerts, et cetera, will be robust, and millennials are a driving force of this trend. There are multiple catalysts. I mentioned earlier in the presentation, catalysts are important to us. They have a $350 million share repurchase authorization, and we would not be surprised if the company used it. Remember, the enterprise value of the whole company is just a little over $500 million. So this is pretty significant. They also have air development rights that also could be sold. In New York, you have a concept of air rights that are transferable. Right now, obviously, New York real estate is a huge question mark about it, but they could, at some point in time, sell the rights that they have above the garden because they're not going to use them to a developer like Vornado, and they can get a $500-600 million for that. Also, James Dolan, might have an interest in taking the company private, and it's interesting to note, before the separation, Silver Lake was the largest shareholder. They owned about 8% of MSG. It's unclear whether if they kept their stake. We're assuming they did. And they have interests in live entertainment, and we would not be surprised if they, at a point in time, teamed up with James Dolan to take it private. So here's our valuation and how we got there. The current share price, roughly $77. There are, risks, coronavirus, et cetera, uncertainty over Las Vegas. But because of those risks, we took a 50% haircut to the cash balance, and we get to $124 per share on a $77 stock. And, I've been very vocal on the Las Vegas sphere and that it's a boondoggle. I wrote a letter to James Dolan that appeared in Forbes. You can go and look at it. But, I certainly could be wrong. And if I'm wrong, we could be, this $124 price target could prove to be quite conservative. The next company I want to talk about is the parent, is Madison Square Garden Sports. And right now you can essentially buy the Knicks and the Rangers for $3.5 billion, which obviously that sounds like a lot of money, but when you look at what sports teams have traded for, it's not. It's a very interesting opportunity. And we think it's curious that they structured MSGS as the parent in this spinoff dynamic. And from our understanding of the law, the parent can be sold at pretty much any time without jeopardizing the tax-free nature of the spinout. And so this is one where, especially if you live in New York, you can see how the negative sentiment on the Dolans there are. I don't think, his heart is in the Madison Square Garden entertainment portion. I think if someone made him an offer, he would sell this pretty quickly. And I'll talk about that more in a moment. And it's also worth noting that Nelson Peltz is on the board of Madison Square Garden Sports, but that might be because he wants really good seats to the Rangers as he's a huge hockey fan. valuations for sports teams have, expanded, greatly over the last couple of years, and the Knicks and the Rangers are the epitome of a trophy asset. They're the ultimate status symbol for the billionaire class. And if the Dolans ever put this on the market, one, fans would rejoice, and two, a bidding war would erupt. Assets like these do not come up for sale very often. I mean, I think that the Dolans bought this in the mid to late 90s or early 90s. And James Dolan, in an interview a few years ago, said he's received feeler offers in the $5 billion range for the Knicks alone. And remember, the enterprise value of the company is about $3.5 billion. It's also worth noting that sports gambling, and with the coronavirus and how state budgets and the federal budget is going to be very stretched. If there was true legalized sports gambling in New York, I know they have some form of it, the value of these teams would go up even more. That's a huge opportunity. So here's how we got to our valuation. We put a 30% premium to the Forbes value. I know that sounds a little strange, because we're generally conservative in nature, but if you look at the last 50 sales of sports teams, they've all gone on average of that premium to the Forbes value. And, so that's kind of where we stood on that. And, it gets you to $218 a share. And I think there's significant more upside if sports gambling does become legal. So I want to thank you for your time today. I really enjoyed speaking to the conference. Thanks for inviting me, and I'll open it up for a couple of questions. And if you want to learn more about us, feel free to contact me, visit our website, or follow us on Twitter @Boyar Value. Thank you.
Awesome. Thank you so much, Jonathan.
Sure.
Very interesting presentation there. I don't see any questions, but I had a few.
Sure.
On this. First of all, Jim Dolan, and I say this as a Knicks fan, I know full well how unpopular he is and how horrible the team is. And I get your case that, dividing this and how he has been good for shareholders if he hasn't been good for the team. But, beyond that, though, Jim Dolan has proven to be pretty bad at this whole PR game, right?
I think you're being kind.
Yeah. Because, just recently now, in the last couple of days, New York Knicks refused to respond to George Floyd's death, reportedly angering staff. Knicks owner James Dolan on George Floyd: "We are not any more qualified to comment." That's just like a terrible thing to say. Even if it does happen to be true, you can still at least do the very least. And again, this is just a small example. But isn't there any risk here that as he continues to, suffer these PR blowups, that it will hurt the share price, at least in the short term?
It may or may not hurt the share price in the short run, but I think this helps bolster our thesis that James is a very wealthy guy. He's not, it's certainly no fun for him to be in the post every day doing this. I think this helps bolster our argument that maybe he wants to get out of this part of the business. If he sold the Knicks and the Rangers, then he would just be another, very wealthy person living in the New York City area, and
with a band. Don't forget, he has the band.
He has the band. He has JD and the Straight Shots.
Right.
Which he can play at Madison Square Garden because he'll still own MSGE. And he can tour with the Eagles, and he's opened up with them. So yes, he can. So he could do that and pocket, $5, $6, $7 billion along the way. I think that makes a lot of sense.
All right. And then the other thing is, and you did address this in the presentation a little bit, but this whole idea of live entertainment It's okay. There is some news now about the NBA potentially coming back, but this is still a pretty big hit to the bottom line. But you think that's all priced in?
Yeah, I think it's priced in. I mean, one for the Knicks and the Rangers, the one good thing about being so terrible is that the season really kind of was almost over by the time coronavirus hit. So there wasn't a huge hit to the bottom line. Obviously, next year is a question mark. Do they, are there games, but just fans can't go in them, and there'll be some sort of hit, but they have the cash wherewithal to go to go through that and to to have that kind of liquidity. So investors should look 2, 3, 4 years out. I'm going under the assumption that in the next 2 years, life goes back to some semblance of normal. And in that case, MSGE, MSGS should be fine. To me, the biggest question mark is the sphere. You spend $1.6 billion, that's a hefty, or 1.7 to build this thing. Maybe he's right. I mean, he spent $1 billion on, renovating the garden in early, 2012, 2013. And it's been a double digit return on equity, double digit return. Maybe he's right on this. I don't know. But to me, that's the biggest risk. I mean, I would encourage people to look at that letter I wrote, James. And, the only comment I received back from Madison Square Garden was I referred to him as Jimmy in it, and they said to please refer to him as James going forward.
Classic. Wow. Okay. And then finally, he has had some ownership, and does, I think, continue to have ownership in other companies, AMC Networks and MSG Networks. What are your views on those? And are you equally bullish for the same reasons?
Yeah. Full disclosure, I own both. I think that, in the last couple, AMCX has gone, and they own The Walking Dead, Breaking Bad, et cetera, as well as Acorn, some streaming platforms. That stock has gone, from 60 to the low 20s. And then about a week or two ago, there were rumors first that Amazon was going to buy AMC, the movie theater company. And then people realized that they were actually talking, or the rumor really should have been AMCX, and the stock has gone up considerably on it. I think it's an obvious takeout candidate. I think the Dolans have really no interest in running this thing. They have great technology. They have good intellectual property. It makes no sense to be an independent cable network. They just don't have the muscle. It's selling at about 3 or 4 times earnings. It's a very interesting company. And Madison Square Garden Networks, what I think could happen is Madison Square Garden Sports. It makes a lot of sense for them just to buy it and to recombine it. Originally, MSGN was part of Madison Square Garden, and they split it up. But if you listen to someone who I respect a lot, like John Malone, he said the two obvious owners for regional sports networks are the teams, or cable net, or a cable company. And I think it makes a lot of sense, especially at these valuations, for MSGS to recombine with Madison Square Garden Networks, because if someone was to want to buy the team, they would also want to have the sports rights.
Very interesting. All right, Jonathan Boyar, thank you so much for that presentation. You can see his contact information here. And again, of course, this presentation will be made available to everybody who has attended and registered. So thanks, Jonathan. Sorry, was that? I just muted you. We're going to say something else?
I was just saying thanks for having me, and have a great day.
Yeah, lovely. Thanks so much. Okay, next up, we're going to switch things a little bit here and completely, actually, switch to the other side of the Atlantic, specifically to Denmark, where my friend Andreas Aen is standing by and ready to give his presentation. Andreas, how Let me see here. I think you should be unmuted. We can see
Yeah,
you.
you can hear me now, I think.
Wonderful. So I'll just let you take it away and go from there.
Okay, perfectly. I just have to share my screen. 2 seconds. It should be done here. You see this? Oh, you're muted. Okay. That's perfect. I'll take it from here. Okay, so first of all, yeah, thanks for inviting me. My name is Andreas. As you said, I'm originally I am from Denmark and living in Denmark. I think my English is quite understandable, but yeah, excuse me in advance if there's anything you can't understand. Yes, okay. So yeah, as Jonathan said before, here's a legal disclaimer. I won't read it here, but we own stock in companies mentioned here, and this is not investment advice. It is his own opinion. So yeah, please read this before looking at our stuff. Yeah, just briefly about Symmetry Invest. So we are a Danish-based long-short fund. Our main focus is on the small and mid-cap space. We mostly target European companies and to some extent the US companies also. We were founded back in 2013 by myself as a former accountant, and today we are 2 full-time employees. We currently manage around $50 million and have been growing our assets really quite steadily over time since inception. We have, I would say, really strong results since inception. You can see them here, outpacing the Euro Stock 600 really at quite a big margin in 7 out of 8 years. And as of today, our fund is ranked as the third, best hedge fund in Scandinavia in the database called Hedge Nordic, where basically most of the Scandinavian hedge fund reports their results to. So this is quite a journey so far, and yeah, definitely hope it could continue. So Symmetry Invest, just briefly about how we approach investing. We do both long and short investments. When I heard about this conference, I actually planned to do like a short thesis. As you can see, our short alpha here accumulated since inception. So the first 2 years we basically just did index short. So yeah, our results matched the market. But since early 15, we started shorting individual names and to make alpha on that side, and accumulated has been a good journey so far for us. And since inception, we have paid money on both sides of the market and created alpha on both sides. We're fundamental driven, as we're still a small fund, we can focus on small niches of the market that is really uncovered. The idea that I would present to you now is there's only one research firm covering it, and it's a paid research firm. So it's really brief research. So as I said, yeah, my best idea right now is a long, so I represent this. So I call it the cheapest stock in Scandinavia. So North Media is the name. It's basically a Danish mini conglomerate. We started buying the name in early 2017 when there was a major event in this name. So one of the biggest segment that was competing quite aggressively with another player, and that player basically left the market. So if co-distribution was left alone with the whole market, and that changed the whole I would say the investment narrative here. But at that time there was 4 segments where really the 3 of them was bad divisions, and then they have this one that just come out of a price war, and we thought was a good turnaround. And the company had quite awful corporate governance, I would say, at that time. And if you fast forward to today, the situation has just changed dramatically. The corporate governance are better. Now they have 3 good divisions, and they have sold one of the divisions. So I think the investment is even better now. So about North Media, as I said, over the last 3 years, they have improved their results in 3 out of the 4 divisions, and the only division they have not improved results in, where they couldn't get it better, they sold it at a profit. So the 3 remaining businesses is, good now. They have good market leading positions in their respective niche here in Denmark, and I think another important point is that the corporate governance has improved considerably over the last year. So both Symmetry Invest and some other Danish fund has, really worked, I will not say as activists, but really as like constructivists behind the scenes with, the new management team, the the new chairman, to work with him to improve corporate governance, and we think there has been quite remarkable success in this point over the last 3 years. And today the company pays out 4 Danish crowns in dividends, so it's like 8% yield. And if I include the 2 buybacks, the total shareholder distribution is more than 10% per year. And really, if you look at price to earnings perspective, this is why we think this is the cheapest stock in Scandinavia. The market cap is 900 million Danish, and the net cash is 500. So based on net operating profit after tax, we think the stock is trading at 2.3 times earnings. So that gives you a picture about how cheap we think this is. So I would just go through the different segments, so to give a brief overview of North Media. So the biggest segment is IFCO Distribution. IFCO Distribution is the market-leading distributor of digital and commercial leaflets in Denmark. So before 2017, IFCO Distribution was competing quite aggressively with a company called PostNord. So PostNord is the state-owned letter business. And that business was taking the state-subsidized letter business and using this to fund the losses in the leaflet business that competed with IFCO Distribution. So it was quite tough for them, to compete with a state-subsidized competitor. But in early 2017, that changed after PostNord pulled out of the market and basically left IFCO Distribution as the only remaining player here. So they got a de facto monopoly here. And since then, IFCO Distribution have gained most of the market. They have raised prices back to where they were before the price war started, and achieved a lot of scale efficiency. So just to mention, the EBIT margin has gone from 5% to now more than 20% in those 3 years. As going forward, we basically see this as a stable cash cow now. So the leaflet business is declining, a few basis points in volume each year, but they can more than offset this by a few percentage point of price increases. And you can see the chart. There is some seasonality in the revenue, but as you can see the purple line, it's growing quite steadily at a low rate. The biggest risk here is basically on a political scale, because politicians they really don't like this kind of business, because a lot of those leaflets, they go into the mailbox, and a lot of people just throw them into the garbage, and it's not good for the environment and stuff like that. But really, the company operates in the EU, so there's a lot of strict rules what the government, the politicians can do about this, and there is really not a lot of stuff they can do to force them to change the way they operate here. Okay, and the next business they own is a business called North Media Online, and this is basically the crown jewel now. For over 20 years, the online business was, loss-making, and they lost around 200 million Danish over 20 years here. But this year and last year, it became profitable. And I think historically they just, did too many things at the same time. But since Mads Dahl became chairman 3 years ago, he basically took the Jack Welch approach here to say, okay, we need to focus on the segments where we're the market leader, where we're the best. So he cut all the investments in unprofitable stakes and focused everything on the rental business. So where's online today? North Media Online is the market leader, at a platform where they connect the tenants with the landlords. So basically, if you're a tenant, you want to go to the platform where all the rental seekers, where all the apartments are. And if you're a landlord, you want to go to the platform where all the tenants are. So there's a huge network effect here, and online is the market leader in Denmark and also growing quite significantly in Sweden now. So this is quite a fast-growing segment. It's profitable. I think they can earn around 20 million Danish this year, and there is a quite reasonable to expect them to grow that to 40 in a few years. They have a small job segment that's still unprofitable, but it's really not important anymore. And I think the chairman will also close that one down at some point. I would say there is actually a little niche here from the COVID outbreak. North Media Online is actually benefiting a lot in recent months from the COVID outbreak. And this has to do with a lot of apartments in Copenhagen and the other big cities in Denmark have been used by Airbnb. And a lot of those, tourism, they can't go into Denmark now to those Airbnb apartments. So a lot of the, apartment owners are now putting their apartment up for rental on the media properties instead of using Airbnb. So from, my industry sources tells me that the business is booming now in April and May because of this. So we think this is quite a good business that is really valuable. And you can see from the chart there that is growing a lot now. So one of the other businesses is a company called Beakey. We actually looked at Beakey for quite some years and thought it was really a black hole. We didn't understand I would call the investment narrative here. But I think over the last year or so, stuff have happened to, it has been restructured a little bit, and they have just found really a sweet spot in the market now. So what Beakey does is, they install a door lock in apartment buildings, and delivery firms can then use a key card, and that key card is really on the iPhone to get access to the building and deliver the goods. And think about this is really important because online delivery is just booming at these days. And when delivery firms cannot get access to the building, they have to take the goods back to the central warehouse and redistribute it another day. So this will save a lot of cost for distribution firms to get access to the customers, and it is also good for customer satisfaction when you get the goods the day you want them. So we think there could be a big advantage here. And currently, Beakey is more than 50% of the apartments in Copenhagen, and they have a target to get to more than 70% this year. And you can think about it, how many apartment buildings want 2 or 3 or 4 door locks? Nobody wants. So they have basically cornered the market here and be the by far market leader. And I think with online delivery just booming, I think the demand should be booming for Beakey, for the foreseeable future also. And to think about the revenue model here, one have to I think about it as kind of a tool booth. Beakey are installing the lock in the doors, so they're paying for the system itself, the installer upfront, and then they basically receive a fee or a royalty every time the door is opened with the key card. So that's why I kind of describe it as a tool booth where you install this, and every time the door is locked up by the delivery guy, you receive like 0.1 Danish kroner or something like that, and just collect that for the every time the door is opened. So upfront the business looks bad because of losses, but I think when the market sees the potential here for delivery booming and the market position in Copenhagen, I think this could be really valuable. Actually, the last segment is a stock portfolio. So North Media has quite a big portfolio of big liquid stocks, and you guys can see the portfolio down here is mostly big Nasdaq stocks and big C20 in Copenhagen stocks. So big liquid firms, and their investment portfolio has done really well over the last 10 years. They have beaten the market a lot. The reason for them to hold a lot of the stocks is really historical. They didn't want to be dependent on the banks anymore after the financial crisis. And also they had this long price war with the state-owned PostNord that they needed a capital buffer at that time. But I would say at this point in time, the management and definitely the new chairman understands that they cannot keep accumulating more liquid assets and stocks. So I think, and this is something we have been pushing them for some time, that they will distribute more and more of this excess cash now. And as I mentioned before, the total distribution to shareholders is now more than 10% of the market cap. So basically, they are doing a lot already. Okay, so my last 2 slides is just about valuation. Here is how we looked at this stock when we started buying it back in 2017. The stock at this time was around 25, 30 Danish kroner. We thought about valuation, around 63 or slightly more than 100% upside when we saw the stock. But the interesting thing here is, if you look at the valuation part, you can see IFCO distribution. So the leaflet business was, really the whole valuation here, and all the other segments we applied a negative valuation on because they were burning cash and we didn't really see a future here. So you had a lot of upside, but you also have the big downside because you were dependent on only one business segment. And the leaflet business, it is fair to give it a quite low multiple because it's not a growing business here, it's more like a cash cow business. But I would say the more interesting thing is we fast forward to today. This is our valuation today. As you can see now, there's really IFCO distribution is worth a little more because the EBIT has gone up. But the interesting point is all the other segments that we think are valuable. The North Media Visa or the newspaper business has been sold at a profit, so they are not here anymore. The online business has really had an inflection point, so it's now growing it's really profitable. So we think it's worth putting a high multiple on that kind of business. And Beakey, it will still be loss making because they install all those door locks up front, but we think at least it's worth 0, because there is a lot of value proposition and a big opportunity long term here, and we think there could be a lot of upside year. And then, there is some hidden assets also in North Media. They own 50% of a company called Lead Supply. And they recently won in Denmark what is called Børsen Gazelle. That is really one of the fastest growing companies in Denmark. I think over the last 3 years, they were growing like 3,000% or something like that. They distribute loans online through a leading platform. And I think, it's profitable and growing fast. So I think there could be some hidden value there. And they also own, a headquarter building where they only monetize around 5% of basically the space there. They only, have it for, sentimental reason. They have the majority shareholder, founded this company and own this building for sentimental reasons. But I think over time they could monetize this building and have, more than 100 million additional upside for the real estate. So I think, the investment narratives have basically changed over the last few years. The downside is a lot lower because all business segments are profitable, and the upside is really good here, and there are some positive things with in both two of the business segments with the COVID-19 situation. So yeah, I think it's a good place. So yes, I was quite weak here, so we have some time for questions both from you and from the viewers.
Yeah, thanks for that, Andreas. Very interesting presentation. Sounds like as much a turnaround candidate as anything else here, with the fact that they got rid of, so they're completely out of the old school newspaper business, the print business.
Yeah, and it was quite funny because they sold it just 1 month ago, and going into this year they had a plan about making it as a turnaround, that business, but I never thought that would happen. They didn't have the scale, so I was applying negative valuation. And then suddenly there was an RNS, how is it in English? A filing to the stock exchange, taking in that they have sold this business at a profit. So I was like, wow, okay. Not only did I have to remove the negative discount, I actually could apply some additional cash from the profit. So that was really well timing.
Mm-hmm. Very interesting. And this trades only in Copenhagen. There's no ADR or even BDR or anything. Right?
No, it's only trading in Copenhagen, but it's trading on the main listing there. So I think most interactive brokers,
sure,
bigger places you can buy it. And I would say from this kind, the distribution business, the funny stuff is it's actually quite easy for me to see how it's going, because each week I get the leaflets in my mailbox, so I can just take them out, put them on the weight, and calculate how much weight they have and how much they earn. So I can have a leading indicator there if something will go wrong before they report it. So that's quite interesting.
Yeah, and that part, I mean, that is still a very big part of the business, the leaflets, right? And how sustainable is that? I mean, it sounds like how awful, you touched on it, just like environmentally, it sounds like a horrible, I mean, I guess you can recycle paper, and I know Denmark has a very aggressive recycling program, but.
Yeah, for sure. And I think the most interesting story about, actually in Denmark, it is the only country where you can have you can decide what kind of leaflets you want. So in Denmark, we have every household are getting the leaflets if they don't want them. If they don't, the default rate is yes, but they can say, we don't want them. So already 50% of the households in Denmark has turned that they don't want the leaflets, so they don't get them. But the interesting point here is that part was growing a lot from 20 to 30 to 40 to 50. But over the last 3 years, that has stalled. So 50% of the households do still want those leaflets. So they just, and the other side is you can actually say, I don't want all leaflets, but I want some of them. So you can go online and choose what kind of leaflets you want. And so the one thing the government want is the one to turn the default rate from yes to no. So basically, instead of consumers have to say, no, I don't want them, they have to go online and say, yes, I want them. But there is some EU law that prohibits this, because this is basically, bad for smaller new players in the market. It will imagine if you go to Facebook and say, oh, I only want those 10 ads, and you cannot display any other ads to me. That's only good for the big companies, you already know, but it's really bad for smaller companies. And also, ethical distribution, they are the largest employer of, youth people in Denmark. They have 10,000 youth employers who distribute this. So they, most of young people, this is the first, job they get. So they actually play a quite important role in the society.
Finally, I don't think you touched much on the balance sheet. Is this company have a lot of debt or any debt?
They have basically zero debt. They have a small
Mm.
amount of property debt, and as you can see, they have a net cash valuation of more than 50% of the market cap.
Mm.
And this is based in 100 million cash and around 400 million in, as you can see it here in liquid
Oh, you
stocks
did
like
have it.
Amazon, Gemmap, Mastercard, whatever.
Huh.
And they have been making a lot of money now. So basically in the first quarter of this year they lost 50 million on the stock portfolio because of the COVID crisis. But as of today they are up more than 50 for the year. So the second quarter we show more than 100 million profit from this.
Wow. Very cool. I mean, this is a great idea. If you're looking for small cap, niche type of things, how scalable is this Bevy thing or whatever it's called, Becky?
The Beaky.
Yeah. Beaky.
I think it's the one thing that scales is first you have to get it on most apartment buildings. So
Right.
they're really successful in Denmark so far because they are close to 60% in Copenhagen now. But then the other part is you have to sign up the distribution firm. So like GLS, it's all the companies that basically distribute goods. It could be consumer goods, it could be online goods, but it could also be groceries that deliver online. So they have to sign up all those companies and then deliver them a key card. And then when they use that, they receive the benefit. So it takes time to get the apartment buildings up and then to sign and there's a little bit, the companies only want to sign up when most of the apartments are done, but the apartments only want to sign up when a lot of the companies are on it. So there's kind of a the egg and the chicken perspective there. But now they are so big that I think they will come, and you can see from the figures it is starting to kind of come out, I think.
Is that the type of thing that could potentially be expanded elsewhere in Scandinavia or?
They are actually doing it in both Sweden and Norway at the moment. And there's not a lot of competitors. So Amazon has something like this themselves, basically, so they can deliver the goods online. But Amazon is not in Denmark yet, and only recently come to Sweden, I think, and not in Norway. So it's not an immediate threat. And in Denmark, as I said, you don't want 3 or 4 of this on your door.
All right. Finally, last question. Since I happen to have you here, how has the COVID thing been in Denmark?
I think, in Europe, we was actually one of the first countries to go in lockdown because a lot of Danish are making ski trips to Italy. So there were some Danish that took, the COVID back from Italy, but our government, reacted, really quickly, took the full lockdown. So yeah, as a fund manager, I had to stay home with 3 kids and manage my portfolio. So at the home office, so it was quite a journey. But yeah, I think I managed it all right. And now it really back to normal. Restaurants are open. I'm back in the office. The kids are back in kindergarten, and I'll go and I could go to summer vacation in Norway and Germany, and yeah, it's
nice.
Really back to normal mostly.
So it sounds like you followed more the German model rather than the Swedish one when it comes to the shutdown.
Yeah. Sweden is a little bit of an outlier here in Europe. Yeah.
Yeah, and nice to hear that you're back at work. We here in New York are not yet.
No.
But okay, well, that was wonderful. Thank you, Andreas, for that. I did see. Oh, right. Somebody just asked you, are you are on social media?
Yeah. Sorry, can I answer here?
You can.
No, I can answer it in phone. Yeah, you can follow me on Twitter, and I also on LinkedIn, and yeah, you can see my homepage also. I think maybe I have it on the first slide.
Hang on, what is it? Symmetry.
Yeah, you can see my homepage and my email there. My Twitter account is not here, but I will definitely.
What is it? At Symmetry? Because I know I've retweeted you.
Symmetry_invest, I think it's.
Okay.
Yeah.
There it is. Okay. So I'll put that out there. Yeah, definitely check them out. Very interesting stuff. Thank you so much for joining us.
Thanks for having me.
Yeah. So let's go now to. I don't want to say it's the main event because they're all 4 presenters are. Main events, and all 4 are valued in their own special way. But Siegfried Eggert of Grizzly Research, you're up next, and you very much don't need an introduction for what you've done on the short side. And I'm very excited here that you have a short idea to present exclusively to us. Before you do, I'll just remind people, it doesn't look like we're going to go all the way to 11:30, by the way, guys. But for now, I am still please holding the embargo until 11:30. But with that, I'll shut up. And Ziggy, why don't you go ahead and take the floor?
Yeah, and I'll share my screen now, so you guys can see the presentation. All right, thank you everybody for listening in. We're Grizzly Research, and we are going to present today our short thesis on Hebron Technology. The company is traded on the Nasdaq Stock Exchange under the ticker HEBT. Let's just talk for a minute about who we are. We're Grizzly Research LLC. We are an activist short seller. We are focused on producing differentiated insights on publicly traded companies, and we are not afraid to share our insights with the public if we deem our insights worthwhile sharing. You should check out our website and our Twitter. Nathaniel already gave a very kind introduction. I'm your presenter today. My name is Siegfried Eggert, but you can call me Ziggy. I'm the CEO and owner of Grizzly Research and manage our team here. This is our full legal disclaimer. You will find that on the website, and you want to read that very carefully. But I won't read that out for you here now. So we won't make it till 11:30. All right, let's talk about the company itself and about the thesis. So we believe Hebron Technology is an inside enrichment scheme, and we also think that there is no economic basis behind this company. So essentially, it's a textbook example why we need tighter auditing standards on US listed China-based companies. Let's talk a little bit about the company in general. So HBT stock price has really skyrocketed in the last year since June 2019. And before that, it has been a very disappointing, or had been a very disappointing story. The IPO was conducted in 2016, and ever since then, the company had been fading to a stock price below $1. Because of Nasdaq listing requirements, they were also facing a risk of getting delisted at that point because of the minimum share price requirement. Over the last year, the stock price, of course, skyrocketed from below $1 to over $20. But the problem is that all major transactions of the last year, during the last year, were supposed and were announced to be arm's length transactions with third parties. We were able to link every single one of these transactions back to the insiders of HEBT and their biggest shareholder, Bodang Leo. This really confirms our belief that this is an inside enrichment scheme, and the publicly traded company is really essentially worthless. So let's talk just a moment more about the background. The legacy business is developing, manufacturing, and customization and installing of valves, pipes for industrial settings, rather boring business, low growth business. The IPO in 2016 was conducted with Spartan Securities Group. It's a pretty shady underwriter, and that company is not even licensed, registered, or active anymore. As I said, in 2019, Bodang Leo got involved. And I'll tell you a little bit more about how exactly Bodang Leo got involved. Bodang Leo got involved in 2019 by selling a fintech company to HEBT, receiving a ton of shares in exchange, and concurrently buying a lot of shares from existing shareholders at a steep discount to market price, at a 70% discount to market price at the time, which then at that time made him, and until now made him immediately the biggest shareholder of the group. So they effectively gave over control to Bodang Leo. Let me talk a little bit about the legacy business. So everything that was before 2019, and before June 2019, that was the only business. Now, we pulled filings from the State Administration of Industry and Commerce in China. These are filings that companies in China have to make to their authorities, and these filings are usually accurate. And historically, it's been very fruitful to take these filings, if you can get your hand on them, and compare them to what is reported to the Security and Exchange Commission. Big differences in these filings, reported numbers in China and in the US, are usually a big red flag and key tell for fraud. In the case of HEBT, these numbers are as outrageous as we've ever seen them. So up to 90% difference in revenue is something that I don't think you can, or anybody can, explain away with an accounting difference. So this is our first hint here that the legacy business is just completely inflated, and everything that they reported to US investors might have been just a lie. We, of course, went a little bit further. So after looking at the SIC filings, we said, well, let's go to the company and look at their valve business, see what's going on there, see if there's people working, see if it looks like a great business. So we visited. The building that we show you on the pictures look actually quite decent. HGPT does not own this building. HGPT rents 1.5 floors in that building. And we were told by multiple locals in interviews, that the headcount right now is 20. So there's 20 people working there. In 2018, HGPT last disclosed their headcount to be 88. Now, so it's one of the two: either the business has just plummeted dramatically since then, or they have been lying all along. I don't think that either explanation bodes well for the company. We also want to mention in that context, that the auditor track record is just a giant red flag, and something that investors could have and should have seen. So who signed off on all these fraudulent, what we believe to be fraudulent financial statements? Friedman LLP was the auditor until 2019, mid-2019. Friedman recently made headlines because they got subpoenaed over their involvement with iFresh, used to be traded as IFMK. So this is just new news. Weiwei LLP, Weiwei & Co. LLP is their new auditor. Sounds like a China-based auditor. In reality, these guys are based out of Flushing, New York. We also took a couple of pictures there, and they have no audit partner actually, or no partner in China. They have been the auditor of notable exposed frauds such as CIFS, which was exposed by Muddy Waters, or most recently HX, which is a company that's under attack from Bonita's research. So it seems to us as if Weiwei is carving out its niche as the auditor who's willing to sign off on anything. All right, so let's talk about the aspects of the business where we really think the fraud happened and really the inside enrichment happened, which is since 2019, June 2019, Bodang Liu got involved, and then this inside enrichment scheme really gained traction. So here's a little bit overview of the events following Bodang Liu's involvement. As I already mentioned briefly, in July 2019, Bodang Liu sold a company to HGBT, and at the same time concurrently bought a huge amount of shares from existing shareholders at a steep discount, at a 70% discount. So this is how he got a hold of the company in the first place. In December 2019, HGBT conducted a PIPE at a private placement in public equities. Somebody was willing to buy shares of HGBT, just normal common shares, the ones that are traded, at a substantial premium to market price. That's of course a big confirmation for a company. Unfortunately, we were able to link the buyers here back to HGBT insiders. In December 2015, they had the big Hengpo acquisition, and on May 22nd, 2020, so just recently, they announced the big Nami acquisition. So these are really the significant events, and we'll go through them here one by one. So the Shanghai FinTech business that they acquired in July 2019 from Bodang Liu looks to us very, very sketchy. Now, here are reasons why we really don't, I explained that here already, why we really don't believe that this company is actually a real company. So in its recent 20F, HGBT disclosed the segment financials for the financial service segment. As you can see, they made about $2.5 million in revenue. It's a 99% gross margin business and about 60% net margin business. Now you believe what you want, but we tend to not believe these numbers or think that this is a business with that margin profile that is absolutely not scalable. Shanghai FinTech is an online financial platform for individuals to be connected to insurance or banking products. The company itself doesn't have any licenses to provide any financial services themselves, so they're just acting as an agent or middleman here. We think the company is probably not that hot. For example, in the last 30 days, they had a total download of 2 for the app. So that doesn't really seem as if the company is even active at all. So essentially, we think that HGBT significantly overpaid for an inactive business. Let's talk about the undisclosed related party transactions. Now we come into the actual hot stuff, where this is violating outright SEC regulations every step along the way. So in 2019, December 2019, HEBT proudly announced that they found investors who want to buy their shares at a substantial premium. This is, of course, a very confirming signal for the market. You know, third-party investors who have substantial amounts of money, who probably vetted the company diligently, are willing to pay a substantial premium to acquire shares. Outside people would think that this is a great thing. And we think that's just a scheme to pump the stock. We were able to link the buyers here that were portrayed to be third parties back to the insiders. And I want to walk you through this example here. So the two people that signed off the contracts as the buyers of these shares are two directors of the respective companies called Xu Shandu and Shan Jiang. Now, these two individuals are actually acting as agents of Bodang Liu, the main guy here and HEBT's biggest shareholder, in multiple capacities. So they're acting as supervisors or legal representatives, or even as shareholders of companies that are either directly owned by Bodang Liu or share the same corporate email address, corporate address and phone number with a Bodang Liu controlled company. This is not a mere coincidence. And these relationships have been in place way before any acquisitions were even in the talk. So this clearly establishes, in our opinion, that there have been prior relationships, and we believe that Xu Shangdu and Shan Jiang are nothing but agents of Bodang Liu. So this is just an outrageous, undisclosed related party transaction to pump the stock and fool US investors. That's our opinion. Let's talk about the acquisition, the next acquisition that happened. So they raised money in early December 2019. And now that they got money, about a week or two later, they decided to buy this great company, Beijing Hengpu. Also supposed to be an arm's length transaction with a third party. We were also able to link this back to insiders and actually conclude that this is an undisclosed related party transaction. The transaction was not announced at the time. The transaction was snuck into their 2019 20F, which was just released a week or two ago. It was an all-share deal valued at the time at $11 million. One thing that we want to mention about the Hengpu transaction first. Now, about 6 months after this transaction was supposed to be consummated, according to HEBT, we find that the ownership has not been yet fully transferred. So in an acquisition like this in China, you would find a share pledge of the sellers to the buyers. Now, this hasn't occurred yet. So technically and also legally speaking, as we speak right now, HEBT bought for a company that it never got ownership of, never acquired. That's just the first outrageous thing with this acquisition. The second thing is that, once again, it's an undisclosed related party transaction. Director and legal representative of the seller here have been legal representative, directors, and agents of Bodang Liu's companies in multiple instances. Now, this network is rather extensive, and I don't want to bore you with too many Chinese names that I pronounce incorrectly here. So you'll see the whole rundown and full relationship map in our report that we will publish. But here's a short overview. Basically, all the people that were acting as representatives and directors of the sellers are also acting and have been acting as agents of Bodang Liu and HEBT in the past. And they didn't even cover up their tracks that well. It was fairly easy to find. This company that they acquired here, Beijing Hengpu, we also want to comment at least briefly on the fundamental value of this company. To make a long story short, we think it's entirely worthless. It's once again a financial service platform that connects service providers like banks or insurance companies, so financial products with customers. So they're just the middleman. On their website, on their platform, there's currently no products that you can buy. So there's nothing that you could buy there. I don't know how they are making money at this point. And the two products that we could find were supposed to be paid back over 3 years ago and are obviously late on payment for over 3 years, which doesn't really look encouraging. This company here, Beijing Hengpu, has the particular spin to lend to companies that are in China listed on tier 3 stock exchanges. So very low quality companies, and we think just not viable business model overall. And a look on their website confirmed that there's no activity. Let's talk about the latest acquisition here. May 22nd, 2020, it was announced. A NAMI acquisition, also announced to be a acquisition at arm's length from a third party. Once more, we were able to link this back directly to insiders and Bodang Leo, HEBT's biggest shareholder, who we think is the main guy to profit here from this insider enrichment scheme. So the transaction was valued at about $25 million with $1.5 million, about 1.5 million shares, and about $7 million in cash. So we have multiple hints that NAMI is actually an undisclosed related party. For example, here in this instance, what I show you here on the screen is a job recruitment posting. And the company on the job recruitment posting actually says that, you know, the company listed on the left, Hui Yingjin Fu HR and NAMI Financial Consulting are one and the same company. Now, NAMI Financial Consulting, we understand it's NAMI. Hui Yingjin Fu is actually a company that's controlled by Bodang Leo. So why do Bodang Leo companies recruit on behalf of this supposedly completely unrelated company? It's a very weird thing. Oh, 1 second, I think yeah. Here's our second piece of evidence. One of the sellers here has been acting already as a Bodang Leo agent in the past. So, for example, he was a legal representative and shareholder of a company that shares the same address, corporate email, and phone number as the Bodang Leo companies, and also as HEBT's current Shanghai fintech company. So this once again makes the very, very strong case that the relationships between these individuals that we're dealing here were established way beforehand, and all the sellers here that write down their names are just acting as agents of HEBT's biggest shareholder, Bodang Leo. The third piece of evidence here is that there's media reports which actually mention the two sellers here, Xin Liu, 15% seller of NAMI, and Jinbao Li, 85% seller of NAMI. Multiple media articles mentioned these people as being basically employees of companies that are controlled by Bodang Leo. So these guys are just employees of his and are presented to US investors as being outside third parties that they haven't known before. This is just outrageous, and we think because our findings are so clear and our evidence is so clear, and we've submitted our evidence to the Security Exchange Commission, this is a fairly obvious example of wrongdoing, of investor abuse, and also, in our opinion, the prime candidate to get enlisted and see SEC enforcement. One more thing about the NAMI acquisition here. I just want to mention that business model here. It's also a online financial service platform. It's a P2P lending platform actually, but we think P2P companies here in China are seeing major headwinds. Businesses see very, very depressed valuations, and we think rightfully so, because regulators in China are going hard after peer-to-peer lending platforms in China. So was this NAMI acquisition worth $25 million or more? No, we think actually this business is entirely worthless. Nobody would be willing to pay anything for it because what you get essentially is a defunct business and some legal liabilities maybe on the back of it. So nobody should be willing to pay a cent for that. All right, to sum this whole thing up, again, you know, in June, July 2019, Bodang Leo got involved and HEBT bought their Shanghai fintech segment. In December 2019, they had their big pipe. Also in December 2019, a big acquisition. And now in May 22nd, 2020, latest acquisition. So what's the net here of flow? This graphic here gives you an explanation. So because in the private placement, actually, the insiders paid some money for these shares, and we would assume that they actually, or hope that they did, suspect that they didn't, but hope that they did. The company actually received some money, but then immediately paid out that money in the acquisition a week later. So net, the company HEBT sent Bodang Dio and his agents $500,000 and shares that are right now worth about $220 million. What did HEBT get in return? Well, no cash and 3 businesses that we think are entirely worthless. That we think if there's a credible, real third-party buyer, wouldn't be willing to pay $5 million even for all these 3 businesses combined. So that's a very, very sad state of affairs. And we think also now that we've called the company out, there will be more attention here on the situation. This basically concludes our presentation at this point. As I said already, we'll be uploading our report at 11:30, which gives you the full background and all the details and all the background information, our sources that we've used for our report. And this concludes our presentation, and I would like to open up to the questions.
Very good. Thank you, Siggy. Interestingly enough, this stock was down 8% at the start of trading today and is down 17%. So you are welcome. Everybody appears to have already profited from this. Hopefully they will remember that when it comes time to sign up for the next conference. But anyway, so you were short here originally back in December, right? And what has changed since then?
No, we were not short in December. I think what is worthwhile noting is that the company, when the stock price first pumped and really started to make a move, I think Geo Investing, which is a great online services, and you guys had Marsh on here as well, very good guy, and they first smelled that there might be something wrong with the company. So that's worthwhile checking out. All this information that I presented here, you had to see the latest 20F, which only came out a week or 2 ago, where they disclosed all that. And I think now the time is really to look into a short position. No, we're not financial advisors. That's just like my personal opinion here. But being right and making money are 2 different things. And at the end of the day, if you want to stay around, you better make sure you make money. So timing is in these, especially fraud situations, something that is a factor you got to pay attention to.
Wow. Okay. What is the borrow?
That depends. I think borrow is readily available on most brokerage platforms. I also didn't see it to be hard to borrow, so it should be a reasonable fee. These things, though, might change relatively quickly. If you're able to get borrow now at a reasonable rate, that's great. But I can't promise you that you will be able to get borrowed tomorrow. These things change, especially with smaller sized companies. Now, this is not a micro cap by any means, about $500 million market cap and a NASDAQ listed company, but it's still not as giant as a Facebook or anything like that. So you got to pay attention to these factors, as you rightfully pointed it out.
Yeah. Okay. Wow. This is really something. So what, how did you find out about this originally?
So, I think this one is one that you could have found really easily on a stock price screen. So 52-week high, 52-week low is a screen that's very simple one that we look at frequently. And, sometimes you just see companies where the performance seems too good to be true. Like you're wondering, okay, well, like what happened here? Did these guys just cure cancer or and then you look into what happened and then you figure out, well, this is very not exciting or actually looks to be nonsense. And then you take a deeper look, as we did, for example, here, put the SIC filing, so that the revenues are up to 90% lower in China than what they tell US investors. Then we go, of course, the next mile and visit their facilities and interview them and interview locals and try to figure out what's going on. Then we look into all the acquisitions and try to become customers there on these platforms and say, well, if this is a great financial service platform, then let's try and test it. And when you're at this point and you can't even become a customer, yeah, you're onto something. But how we found it, just simple 52-week high screen.
Wow, that's really simple. Amazing. Okay.
Let me maybe comment. I think you're just to give you a little bit more color. I think on where your question's coming from. finding like the ticker in the first place is not necessarily the biggest challenge.
Right.
There is no replacement for digging through the SEC financials, reading the conference call transcripts, talking with people who know the company well, talking with people who used to work for the company, maybe suppliers, customers, stakeholders of different kinds. And when you do that type of work, you really figure out what's going on. So we probably looked at I looked at a bunch of companies in the last week that have big fraudulent aspects, which I should have discovered and I just didn't see. So it's not about not knowing the ticker.
Very interesting. Okay, any other questions? I don't see any popping up on the Q&A. Great. All right, wonderful, Siggy. Well, thank you again so much. You are obviously on the Twitter as well.
Yes.
Grizzly, I forget, what's your...
Let me see. Yeah, it's at Grizzly Reports, I think. But you should, like, if you just Google Grizzly Research, you should be able to find it, yeah.
Very good stuff. Awesome. Well, thank you so much for addressing this with us. And again, you'll be circulating this out at 11:30, and the recording of this whole thing I'll put out later, probably tomorrow or later today for attendees. Awesome. So let's go now to our final presenter for the day, which is David Neuhauser. And oops, are you there, David? Hello, David.
Yes, I'm here.
Wonderful. So I'm on an echo there for some reason, but that's are you, what kind of a mic are you on? Well, it's
I
okay.
just got it.
I can see you, which is great. So are you able to share your screen, or otherwise I can do it?
If you could do it, please, Nathan.
Yeah, all right, hang on. Let me pop this open here. All right, here we go.
Yeah, so hi, my name is David Neuhauser. I'm the fund manager at Livermore Partners. We're based in Chicago. We're an event-driven hedge fund manager that's been around approximately 10 years. We've had a fund for about 4 years. We started with just some managed accounts and some high net worth investors. And now we've focused on...
David, we lost your audio.
Oh.
All right, well, here you see his presentation.
1 second, Nathan.
Oh, there he goes. Yeah, now we can hear you.
All right, let me see what I can do here.
We sound you fine.
Okay. All right, so yeah, we've been around.
Now we lost you again. Just do me a favor, just tell me next when you want to go to the next slide. Oh, we lost them all together. Well, here you go. Yeah, these guys have been around. Well, I'm not going to do his presentation for him. I'll come back in a minute. Hopefully. Okay, well, it looks like David may be awash today, folks. I can tell you here his picks. We got, hold on. Soul Gold. There you go. David is also on Twitter. Let's just give him a minute here to see if he is able to sort out his problems. And hopefully he will. So glad that we did a pre-call where we tested all these issues. But such is life, I guess. Are there any questions for the other panelists, some of whom are still around and are able to answer them? All right. Well, I guess there's no point in hanging around here. Yeah, the embargo is lifted, by the way, guys. The news is out there on HEBT. And unfortunately, I guess David, you'll see here, you can, again, his presentation will be available. I'm going to put that up right now. Apologies for this, but I guess technology is, oh, there he is, connecting. Okay. Hello, David.
Can you guys hear me now?
Yeah.
Apologize for that. Just having some computer issues. Is that okay?
Yeah, go on. I was going to say, just say next when you want to go to the next slide, okay?
All right, sounds good. All right, so back, Livermore Partners. I've had Livermore Partners about 9 years. Like I said, we're an event-driven fund out of Chicago. We focus on event-driven special situations. We do a lot of work in the resource space, financials, but remain agnostic to different themes. So over the past, like I said, 9 years, we've run about 8 activist processes. I'm on 3 different boards, and we've helped unlock substantial shareholder value over the years. For being a small fund, Livermore's had an excellent track record. And again, we've invoked a number of processes with unlocked returns. You can go next, Nathan. So our current performance, we're down this year having trouble, and I think mainly that's given to our overhang of last year. If you see our returns last year, and even if you see our returns over the past 4 years, they've been exceptional. So on a return over the past few years, we've generated a return of over 300%, which is better than the S&P. You can, next one. Now, the first company we're going to talk about is Vista Oil and Gas, which is a stock we actually followed the last few years. It's a small oil and gas company with about 700 million enterprise value today. Vista was a SPAC formed by PE giant Riverstone Holdings about 4 years ago with the goal of developing the Vaca Muerta play in Argentina, which is supposed to be the next great shale play. So what interests me about Vista is they have very strong leadership and management team. They have a number of undeveloped locations in the Vaca Muerta, over 400. And they also have an interesting dynamic where they have conventional wells and they have their shale wells. And their type curves on their shale wells, which they haven't drilled that many, have been beyond what their expectations have been. So in the current price environment, we had oil go down, Brent down to $20 a barrel. It's now rebounded closer to $40 a barrel. Argentina put in a decree just a month ago, which means that between now and the year end, they'll be receiving a $45 price for their oil. And to me, there's the intrinsic value of this company is substantially more than where it is today, trading in the low $3, like around $3.30 a share. You can go to the next slide. And this just tells you a little bit more about the basin itself, the Vaca Muerta, which again is in Argentina. It talks to you about the wells in terms of the P10 over the Permian wells on the right side. And it just shows you that one is the wells are exceptional to the Permian. The other is that the total organic compound TOC is greater than the Permian as well. So there's just great density and great porosity to these wells, which makes them exceptional. The downside to the company, I would say, is again, it's a growth avenue. It's one that needs to be developed. There are some super majors there in region, as you see on the slide on the left with YPF, which is the national oil company. You also have ExxonMobil, Total, Shell, and others. So they're an independent, and they're one of the largest independents in the area. Next slide. And I'll just last on Vista. What I like about it again is the stock has been blown down. They IPO'd in New York essentially last July at around $10 per share, which was about $1 billion market cap at the time. Since then, you had the Argentina elections, which saw the stock slide down to about $5 a share. And then, of course, with the oil slide, the shares have gotten down to around $3 a share. Also of note, there's some large fund managers who've been buying a big stake, including Seth Klarman owns, I believe, over a 5% stake in the company. Livermore owns a stake in the company of a great average price. And I think it's one of those companies that Vista, on a recovery in oil and further development of the field, you can see the shares double or even triple over the next 24 to 36 months. So our theme on oil and gas is very similar to gold and other resources like copper. So what I'm doing is essentially looking at these really small, unique companies that are small cap in nature, but they have really solid management teams and they could deliver and execute on their business plan. And when you find those teams and those assets, you have to invest in them on severe weakness. And over time, as it gets execution, you can see double and triple your value. And at Livermore, we've had a track record of doing that now for a number of years. We took an activist stake in one of the larger miners, Detour Gold, which is our last activist stake. We did that about 18 months ago. Detour, our average price was around $10.60 in Canadian terms. We helped push to change the board and the management team at Detour within 18 months. And just last year, Kirkland Lake acquired Detour at over $23 a share. So our next company we're going to talk about here is SolGold. Again, similar to Vista, where we think they have very strong entrepreneurial management team. But again, this is a different resource. And oil, I'm bullish on over the next 2 to 3 years. In the short run, I think oil is still going to be in a very tough position, but that's when you need to acquire stocks. SolGold, different aspect. They're in the gold and copper resource focused company, and that has been in a bull market here for the past almost 2 years now. So SolGold is listed on the London Stock Exchange. It has a market cap of about $500 million. It's run by a guy named Nick Mather, who's a serial entrepreneur and has sold about 5 different companies. SolGold has the Alpala asset in Ecuador, which is this massive copper gold resource that is one of the biggest discoveries in the past 10 years. So we like SolGold for a number of different reasons. On the event-driven theme, it's a great asset. You have some big shareholders that own the stock, including BHP and Newcrest. So you have commercial players that are invested in the company. BHP is the largest holder with over a 14% stake in it. So to me, that gives the potential optionality where the company could be a takeover target. The stock's currently around 23 pence a share in London. It's up about 15% of the year, so it's having a good year. But if you look back, it's actually been a much higher. And the net asset value, net present value of the Apollo asset is somewhere around over $4 billion, which will take, again, significant resources to develop it. And that was one of my theses in terms of SolGold will look to either a partner or will look to be acquired outright, which you can see the share price then double from the current market cap. And we think, again, well-run company, great asset. It's in a bull market. I think the downside risks are, again, similar to Vista, which you have political instability in South America. It's also, of course, an emerging market, so you're not buying something in the US per se. But again, to take that risk, you see massive potential and optionality in both company shares. And those are things we look for. And that's how, again, we've been able to have strong returns in the past number of years. We have another slide. Yeah, this just talks a bit about Ecuador and the different belts versus other different mines, which again, for SolGold, it shows here that Apollo is just this massive deposit. And we think, again, it's very attractive to a number of potential suitors. We have another slide there. And that just talks a little bit more about Livermore. And again, we were looking at situations like Vista Oil and Gas, like SolGold and so many others we've been involved in. And we like the resource space. We think there's a path forward as all the debasement happening throughout the world with global stimulus is going to ultimately lead to inflation or even potential stagflation. And with that, you want to own assets that are tied to inflation. And there's no better way to do that than to buy discounted assets that obviously will appreciate more in value as that comes true.
All right. Thank you, David. Apologies again for the technical difficulties. Would seem almost unavoidable nowadays with these things. But yeah, very interesting presentation. I mean, you do mention it here, the downside potential. It does seem that, you know, the V-type, I mean, it is priced in now, the V-shape economic recovery, right? Or appears to be almost.
Mm-hmm.
We're not economists here, but how close are you paying attention to that, and how, you know, I mean, obviously we all know copper tends to move with that pretty closely. And also China is the big buyer of copper, aren't they? So, and if the Chinese economy slows and wouldn't that, if there's, you know, global demand for copper that kind of falls off a cliff again, yeah, how big of a concern is that?
You know, it's always a concern. So, but I would tell you that that's been a concern for a number of years, and that's led to a lot of less investment, less capex in new mines and new projects. And I've never been a big gold bug, but in the past 2 years, like I said, we started taking over a 10% stake in specific miners. Based on the fact that you're seeing all this stimulus and the fact that you're also going to go into deficits in terms of production, both on things like gold or even copper, and you're just not finding the kind of discoveries that you have in the past. I mean, remember one thing, that the Fed can't print gold, Fed can't print copper, and these assets also take a long time to develop, even once you have a mine, and also on budget, on cost, and profitable. And our focus, even as shareholders, on a number of the companies we're involved with, including Jadestone Energy, which was an activist process years ago, is we're trying to focus these companies and these management teams on delivering profitable, on-time projects so that they're actually shareholder value. It's not growing volumes just for the sake of growing volumes in production. We think that's a failed process, and you can see that in any type of Permian assets of an oil company, where they've grown production through mostly debt for a number of years, and then when you have prices capitulate, all of a sudden those companies are looking for our cash. Our Jadestone, my example, is just that we're a free cash flow company. We have zero debt. And these companies, again, are younger, more development stage companies. But Vista does have 25,000 barrels a day of production with, just like I said, a long pipeline of potential to grow production over 100,000 barrels a day, which would make it well back over to where that high was you see there in July of 19 of $10 a share, I think potentially even higher. So you have to look out a few years on these things. And again, we're trying to buy them at levels in which we think the intrinsic value is at least double where they're at today. And on both those companies, we see that. So the view today is, like I said, that there's been a lot less investment in the sector, a lot less mines. So it always concerns me, like you said, when you talk about global issues going on in terms of the macro. And today, like you said, the market is just a few percent off where we started the year, which is ultimately amazing to me. I think it's liquidity led. And again, if anything, that shows you that at some point in time, you want to own resource-based hard assets instead of some of the tech.
Yeah, a question here just came in from the audience. Fair value of Vista Oil. Do you have one?
I think for Vista, again, you have to be able to plug in what do you view the nominal price of crude oil for 1 year and 3 years and 5 years. So the positive for them is that they are trying to, even today, they shut in some of the shale production. Their goal is to be cash flow neutral this year. They obviously had this decree by the government of Argentina at $45 a barrel Brent for the rest of the year, which obviously gives them great flexibility to have that break even. But the goal is you don't want to be a break even company. You want to see their production gain and their cash flows generate substantially, which will take more investment. So you're going to have to see them putting more money in the ground over the next few years. But again, the results on their on their wells has been substantial. And I would say fair value, even under $45 to $50 Brent, which I would say be the next 2 years at least, I could see the shares rise back at least around that $5, $6 range, which would be about a 500 million market cap. I think under, like I said, the growth scenario, remember, this is a growth company, unlike a lot of oil companies. I think the growth scenario is once they're able to start delivering further new wells and you start to see the type curves on that and the production growth and oil normalize, the stock has just huge potential, because then I would argue that, fair value could be somewhere around that $9, $10 price point. And I think if you can really accelerate the productivity and the wells over the next, say, 3 to 5 years, the stock does have the potential, I'm saying, to get to be more around mid-teens, even $20 a share under some bull case assumptions.
Right. You're an activist investor. You do a lot of activist situations. Do you know the management of these companies?
Yeah, so one of the things I like about both these companies is I know and have met both of the management teams. Vista has actually been here through Chicago, so I've always maintained a strong contact with them, and even get together with them when I can. And the same thing with SolGold, and that's what I really like is they're both proven leaders, proven management teams that will develop things and eventually sell them. So Marcio Galucio is the CEO of Vista Oil and Gas, and he used to be the CEO of YPF, which is the national oil company there in Argentina. And again, so he has all the, he has great connections in terms of government. He has great connections in terms of the space. He's got great connections in terms of the investment space with Riverstone Holdings, the $27 billion private equity firm, is an investor, took it public, and they still own, I believe, around 12% of the shares. So you have huge backing. I think you have a number of pension funds that are invested. The Abu Dhabi, I believe, pension funds invested in Vista Oil and Gas, and as well as CPP in Canada. And then you have some other just larger investors, like I said, Seth Clearman, who's a new investor over the past 6 months to Vista Oil and Gas that owns over a 5% stake. So we're in good company is what I'm trying to say. And I think they see what we see, which is the assets look strong and the management looks strong. And you really need both in this kind of environment to see a big upside.
Yeah. All right. Well, there you have it. Vista and SolGold, David's 2 picks. SolGold, thank you so much for that. And there are no other questions. And I'm trying to think if there's anything. I don't have anything. So that pretty much concludes this webcast. In closing, I would be remiss if I don't throw out a quick shout to my own podcast, the Contrarian Investor Podcast. You can listen at contrarianpod.com. For present purposes, I should have a slide prepared for that purpose as well, for when there are certain issues. But anyway, so this was great, very exciting. As we speak here, the shares of HEBT are still moving down. They're still dropping. So please do remember where you heard it first. And with that, I'll close this and look forward again next time. Oh, please just also keep an eye out for a survey that should be coming through. And I believe there may be a small promotion if you participate in the survey for future conferences. And anything else, any other feedback, of course, please do send it my way. My Twitter is Nat Baker. That's my personal Twitter. And the Contrarian Pod is Pod Contrarian. And you can email me if you like, also natbaker@gmail.com. So yeah, so that's it. Let's close this here and have a nice day, everybody.